Hello, and welcome to another episode of the Quickview. On this episode, it's going to be a very interesting video in terms of what I've picked, only because this is something that I've learned about by being a very studious person, but I think a lot of people get very confused about it, and it's the stock market. So, the first thing that I've learned is that the stock market is designed to screw you over. Every single step of the way is designed to screw you over. And a lot of people don't understand money, and this took me a long time. Normally, when it comes to stuff, I like to really be studious. For example, with someone like Chris Chan, I really got into all the lore, so I really studied just to see what was going on with all that. And for the stock market, especially since my brain isn't really mathy, it's very hard to totally understand what's going on. And the fact that it really is a very, very hard thing for normal people to understand. It kind of is a scam at the end of the day. I'm still going to be putting some money into it for retirement, but you should really try and get more physical assets such as gold or property if you're if you're that wealthy. But the thing is, it really makes a lot of sense. So this is like mind screwy type stuff here, but let's just say you have $10 to invest here. So if you have $10 and you put it at a bank, and I'm just doing simple numbers so people's brains don't totally fry. Even my brain kind of fries. So if you are in a bank, you only get like $1 in interest over a year. 1% interest equals $1. Now, if you take this money and leave it, it will never outpace inflation, which is something that is obvious in today's market, but even still, you would think that if you have $10, if you boosted it to $10,000 or $1 million, if you're at 1% inflation, $1 million is constantly shrinking and shrinking and shrinking and shrinking because it's not actually worth the $10 anymore. It's realistically worth about $7 to $8, or like even less in some cases, which is just so hard to think about. 1 second, 1 second. Sorry, my wife called me about something. So, anyway, where was I? Yeah, so if you have $10 and it's in the bank for 10 years, it's like worth $8. And no matter what you do, you can't just leave the money in the bank because you'll never outpace inflation. So the thing is that in theoretical terms, it is better to put money in the stock market. However, like let's just say you put $10 in the stock market, and then you have an average growth rate of 6% equals $16, which is like, ooh, that's a lot more alluring. Like, wow, I have $16. That's so much better than the bank. But the thing is that they totally trick you. So let's just say you put your money in the stock market and you somehow hit it big. You somehow found the one stock that went from $5 to $10. You literally double your money. So now your $16, if you take that money out, you have 42% capital gains tax on it. So it's only really good for a long-term investment, which should theoretically keep up with inflation. Should, mind you. Now there's so many different types of stocks as well that it's really just such a huge headache in terms of regular people, and I think they do that to totally make you dependent upon people who are experts, when realistically experts are no better than anyone like me, a layman who is informed and made decisions on his own. Like my friend, he was talking about investments in his 401, and I wasn't really a person who did any investing into my retirement until now, but the one guy who I was with was saying, okay, let me write this down. So he was saying, you're so young, you need to do this, and this was not my financial investor. He was like, you need to put all your money and tell them to go aggressive, 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 aggressive as humanly possible. And I was like, okay, well, and that's where it kind of just the ball kept on rolling. Where I was like, okay, you need to be safe, right? Because the guy who I was with after I talked to my financial advisor, if you have 5 stocks, this is what typically happens because there people would be making the thing that I told him, as I said, okay, you're telling me that you can get, if everyone had retirement, they would all pick aggressive and they would all be sitting pretty. You would know everyone in retirement is making so much money. It's like literally not even funny. So I was like, okay, well, why would that be the case? Why wouldn't everyone pick aggressive? Is because if you have 5 stocks, what typically happens is 4 of them eat dirt and then one of them goes up. So these 4 just kind of counteract each other, making the whole gambit completely useless. There probably are some people who make a slight amount of money, but it's so negligible unless you have an insane amount of capital to play around with this stuff. Because, like I said, you have 42% of your stock. Even if you were to have stocks that are worth, $10, you're literally talking about like $4.20 per each transaction, meaning that if you had a $500 win, you're talking about basically half. I mean, if you even had 1,000, it's $420 on the capital gains tax, and then you have other fees if you were to use this in your IRA, which is non-taxable, but potentially not if you were to use a Roth IRA. So it's like you can't just take the money out whenever you want. So you have to play the long con. And for me, all the only stocks that I do are just dividend stocks and index funds and ETFs, which are basically the top 100 stocks like Apple and all that stuff. And you just basically pick a whole bunch of them, and they're just in one. Now, the only problem is that's based upon the market's growth, and if you have market, the machine always goes up, the machine always goes up, you're good. But in terms of years where, like, when the tariffs were announced, everyone's retirement went down. So that's why I'm not putting all my money into it, because it's just such a tricky beast. Because, like I said, you can have it's safe is how you do it, but even then, you really are not. It's such a weird thing, especially with math. So this is what, like, I finally understand it. I'm not a savant or anything, but the fact that I can understand that makes me at least a little happy. So why people say they want. Okay, so if you have an aggressive stock that's at $100, I don't know why I went from 10 to now I'm doing 100, but if you have an aggressive stock that goes up to, let's just say 20%, unrealistic, but 20%, the value of the stock went up more than the dividend given you in your passive income. Like, this would only go up about 10%, but you get a dividend of about $1 each quarter, meaning you get a total of $4 a year, meaning that this is always going to outpace this passive income. But in terms of the market, if it ever goes down, you always want to have this passive income here, because you can use that as buying opportunities for lower stocks on the dips, which is what most people say to do. And it's kind of insane that really is something that you have to kind of get over, that if your money is going down, you just need to basically disconnect from it. As long as you've picked safe stocks that are recommended for like long-term success, you wouldn't want to put all your money in. Now I do have a few things that I would want to like put in. If I had play money, oh, I would. I have a few things that I think are really going to be blowing off in the few years. I think anything to do with dogs are going to like skyrocket. Anything, and then sports betting. I think sports betting will be even more profitable than it is now, quite honestly. Those are the only two ones that I would say take a risk. But a lot of the ones that I even looked up on YouTube are the people who thought about it. There was only one guy who actually had a really decent idea. The rest of them are all just kind of grasping at straws. Um, for example, someone during COVID put all of his money into Levi's because he said, well, everyone got fat because they couldn't go to the gym. And that was like so stupid. It almost hit the nail on the head. I'm like, wow, that actually was really, like, that was intelligent. That was just basic. How did I not think about that type things? But in terms of the stock market, it really is just insane that you could have one day where, like, take Tesla, for example. Their stock was at, in the beginning of the year, 200 times, I mean, it was like $400. I mean, I think it was like 450 if I'm not even mistaken. I don't have the data on me right now to back that up, but like if it was at $500, it's now like $200, and it's just because of one guy said something. That's your entire hope of retirement is tied upon people just saying crap, or if they had a bad year, or not even if they had a bad year, if they had a less than advantageous year, your entire retirement is just going down. It's just like mind-boggling the amount of factors that are into it. I mean, you could be the most intelligent picker in terms of what stocks you do and in terms of what strategy you use. Some guy could just say something and then like that's it. It's just so strange that that's how we do it in our country. It's very weird because a lot of people are just so uneducated to the point where I can at least rationalize with somebody. Like the first time I was with my financial advisor, I was like a deer in headlights. I was like, I don't know, I guess moderate risk. And then I talked to him the next time. I was like, no, basically, all I want is dividend stocks. I want growth. I want slow and steady. I don't care about anything else because anything else is kind of just stupid. Which I still honestly believe if you're going to make money in the stock market, you basically just need to buy and hold. Buy companies you think are going to be around for a really long time or just have dividends because, stocks like Coca-Cola will always give you something. And it's really strange, too, because, like I said, Ford and Tesla, I know I didn't say Ford, but Tesla produces less cars than Ford, but Tesla is worth more. Literally mind-boggling type stuff. I cannot even believe, and that's stuff that just does not make any sense. Costco and AutoZone are $1,000 at the time of this, $1,000 stocks or more. I mean, it's not even that much. I mean, they don't make that much money. I think Costco does, but AutoZone, I mean, it's just crazy to see what people, or Netflix too. Netflix does not produce anything, yet their stock is hundreds of dollars more than Lucid, a car company. It's insane. It's insane what is important and what is not. Oh, and also, if you would want another long-term stock idea, being a plumber, I know that eventually they said that the water potability, meaning drinkability, is coming up due on the next time they write the code books, and every new home will need a water filtration system because of the fact that our water is not legally potable. It's basically on the teetering edge right now of what is potability and what is not. So that's the only other thing that I would bet the farm on, at least a little bit of money. But it's just insane that stocks like, oh, and you know what? This is another thing I thought. So this is another lesson in economics that just to me just boggles my mind. So I was thinking that I was going to be a smart guy here. So your U.S. dollar is worth $1. Let's just say South Africa. Let's just say Brazil, because this is where it mainly happens. But let's just say the Brazil dollar is worth 50 cents of the American dollar. I was thinking that you could just buy more stocks in Brazilian money because they had a higher they have a higher dividend yield. Like a lot of them have like 10% or 20%. And I was like, okay, well, you could buy as an American more international stocks, and then, with an emerging market, like Brazil, or if you go into a gold company or like oil or whatever, just slowly get something that's just always going to be around. But no, it doesn't work like that because they have because the American money, the American stocks have more flow up and down because more people put more money in the American dollar stocks. It makes the stock worth more than the Brazilian money. Even if you had $100,000 to buy 100,000 Brazilian stocks, no one is going after that stock. So your volatility and your levels is pretty much like this, which means you're not going to outpace the growth that you need to beat inflation. It's mind boggling. You think it would be like as dumb as that? Like I have $1, Brazil has 50 cents per my dollar. How would this not be like a money making printing machine? All of the stuff really just like pulls back in your head of what you were taught as a kid, and your financial literacy really starts to show, where it doesn't make any sense. How would this not make any sense to a normal person? But then you start to unravel it, and you're like, well, no, this really wouldn't be because no one's putting money into the Brazilian market. So the stock market isn't going to reward you by just like, pushing it up. It's going to be consistently flat. Um, Not only that, there are actual other things that should dissuade you from going to getting international stocks, because in some of these countries, the companies, if they don't pay your dividend, there's really no legal repercussion. In the United States, they have to do it because there are so many laws and regulations. So I can't even, like I said, I just thought that'd be something funny. So another thing that's really insanely funny is that you have puts on stocks, which it's basically the equivalent of betting. This is what took me. I kept on watching so many Wall Street bets videos, and I could not understand what they meant by all this crap. So I won't even go through the whole thing like puts and everything else. But you can basically bet on a stock if it goes up or goes down. You even go in through like 50, I mean, you literally go within like a cent variable, and if you buy something, you're basically buying 100 stocks at that price. Now, the insane thing is, I probably should just flip this over anyway. The insane thing is you can lose more than 100% of your initial bet on this thing, which I couldn't even believe was possible, but mathematically it does actually make sense. So let's just say you have a Tesla stock for $100, you think it's going to go up to $200. So a lot of these things are just, again, it's so like mathematically hard. It really starts to hurt your brain after a while because you're thinking about stuff that just doesn't even technically exist. I mean, it does, but there's no tangibility to it. It's just fake things we kind of, agree that exist. So if you want to bet that your Tesla stock will go to $200, you have to pick it within literally the correct day, month, time, I mean, even hour, because the stock market closes. And if you get it right, people will want to buy your stock that you basically have as a bet out there that your stock is at $100 when the stock is worth $200. So you would think that that's something that's common, especially in terms of the stock market, where a lot of things keep changing on a daily basis. That you could do something where you think Tesla is gonna make a ton of money because they got a new model car coming out, or like Apple has a new phone coming out. So, simple stuff like that people think. But again, if your earnings report is not literally we doubled our profit, it always has a chance to just go down. Or sometimes it's even good and it doesn't matter, which is insane in terms of the money. But if you get this right, you made a decent bit of money, and that's what Wall Street Bets kept saying is, "Oh, I made all this money," and that's what made me think like, how are they making this much money? But they're basically It's the equivalent of getting the lucky lottery ticket. It is so minutely, inconceivably possible that someone would bet. And again, like we're not talking. I'm. Not, they're not talking. They're making a reasonable dissertation like $100 to $105 or $101 over the course of a month. No, they literally do it the next day. It has to go up by like $5, which in terms of the market is just inconceivable. It's just barely even possible. But they're so dumb because they don't have the financial literacy that they're able to make that bet, and it rewards them, but they're also stupid and they do it again and makes them lose all their money. So it's like kind of a lose lose situation. But let's just say you got that right. Now the most insane thing about this is if you bet on let's see, if you bet right after the election that Tesla stock would go up to $200, and this is what's put. Well, no, it would be. Yeah, well, we'll just say that this, because that's going into puts for the next part. But if this is going up, then that means you're good. You're golden. But if it falls short of its $200, that means that your $100 thing. Well, actually, it wouldn't get to that point, but you still would have made a profit from this even going up $5 because it works like that. Just trust me. If it ever falls below $100, if you bought 100 stocks at $1 and it's $100, and you went down to $50, you have to sell this stock at a certain time at the end of it. You just can't keep re-upping this. You basically place the bet that on this day, this month, this time, this hour, this year, it will go to this point. But because of that, your $100 can go below what you started out with, meaning that you're negative $50. And this is on something that's small. It's literally insane that you can do something like that. It doesn't make any sense. And then, oh, you know what? Going back to, do I have this on the other side? Yeah, I do. So now you might be thinking, well, if the foreign currency doesn't work, if the risky behavior doesn't work, if the stock market betting doesn't work, then what works? Why can't I? This is another thing that I thought. I was like, well, why don't you buy a bunch of penny stocks? Sounds good to me. It's the exact same thing. The volatility isn't there to drive up growth, so you're just basically putting a bunch of money into something that maybe a bolt of lightning might come out and actually save it. But it never would be that way. If you have a stock that's like 50 cents, it's barely even on the stock market right now as it is, and there's some that literally they do not. They're in the midst of being bankrupt. If you look at the cheapest stocks on places like all those stock market things and stuff, it's so mind-boggling, all this stuff. I can't believe I've talked for like 23 minutes about this, and I'm still realistically not over, because there's so many other things too in your Roth IRA. You can't even put, like, this is how it's so greedy against you, that you can't even put as much money as humanly possible into your IRA and just let it ride. You can't even do that. It is not allowed for you. Let's just say you have a really good year and you're really concerned about your retirement and you want to retire early. You're trying to aim for something like 60 so you can go out and do vacations and stuff. So it is right now, you can only put $6,000 tax free a year. So that means that your retirement is based upon you being fiscally responsible with your own money, on your own time, on your own dime, as well as the government only giving you a pittance of $6,000 a year. I mean, and even if your employer matches it, you only get up to the $6,000. So if you're working for tons of years, I mean, $6,000, and most people don't start retirement until they're like thinking about their retirement until they're like 30. So 6,000 times 40 years, you're only putting in $240,000. And you're hoping that the government and the stock market will all work out correctly in your favor, that your $240,000 will turn into a nest egg of a couple $1 million. But even if you get to the point where it's a couple $1 million and you retire, like my aunt with the stock market problem, she's at the age of retirement, and then the market went down, and then it would be the same case in 2008 or the dot-com bubble, where you literally have the money. It was worth $1 million one day, and then it's worth like $750,000 the next, and that's not even true because most people aren't fiscally responsible enough to start saving that much money. So you get boned every single step of the way. That's what's just so insane to me about this thing, is that you have to almost be insider trading, which I bet a lot of people are, and like that's who's making all the money here, in terms of the people really higher up. But you have to almost be insider trading, or you have to be really good at guessing, or you have to do what I do, where is don't be super committal about it, but just put everything and just slowly let it ride. Because I mean, even with compound interest, $240,000 is like nothing. It's gonna be worth less in the future as well. So you have to keep that in mind. Just because you put $240,000 into it doesn't mean you're gonna be getting the equivalent of $240,000 when you retire. It's gonna realistically be, I mean, with the rate of current inflation, probably there's going to be something going on with the money system before I die. Probably in my case, I think my parents will probably be fine, but it's going to be the equivalent of putting like $120,000 in, and then you better hope nothing happens to it. I mean, even if it's federally backed by the United States government, it's technically not backed by anything. I mean, it's just imaginary numbers. It's not gold, But the thing is, what's insane is even if you do put all this money in and you get everything right, it can all go bad one day. And even if like you want to take out money, let's just say you're in a predicament. Let's just say you wanted to take out. Let's just say you saved up $100,000, and you are, you're 50. Your thing's like worth 300,000, and you need to take out $100,000 because you had surgery, you just got recently disabled, whatever. We'll just say like 50K, because 100,000, you're something's really going on. We'll just say 50K, because that can be something that you need to do that. It's like you literally get screwed over with the $50,000, because now you're getting taxed on your own money you put in to your own retirement. If you take out that money early, and even if you need it early, you are still getting punished due to the fact that you can only take out X amount of money at certain times. So if you got to the age of about, I guess we'll just say 60, you finally want to start using it, you can only take X amount of money out per the federal government. You can't just take it all out at once, because then your money would be worth the most at that particular moment. If you had like $1 million and you took it out when you were 60, it's still worth more in that current time. But you can't just blow it. You have to literally only take out a small amount. So it's not even really your money. It's just so weird to think about. None of it's really your money. It's all fake. Every single thing. But if you think about the money system, it's all just fake. There's no real thing to it. It's all just numbers on a screen. I hope that this has kind of semi shown you how hard it is to really grasp a lot of these things, and a lot of the strategies that I thought would be, how isn't this just a cakewalk? How doesn't everyone do this? When it's really just, no, the only way to do it is just slowly build yourself up. So that's kind of just an overview of stock market and investing. So I hope you enjoy it. It was definitely more than a quick view, because it really is a rabbit hole at the end of the day. But it's something important. It's where you put your money. It's where your retirement is. But people don't understand basic things about it. People don't understand where their money's going in their own retirement. People don't understand that. So hope you have a good one.